In terms of home prices, there's just such an ongoing shortage of homes for sale. It's hard to envision a scenario where home prices fall.
Jeff Ostrowski, we had you on about 6 months ago, and just so people know, you're an award-winning journalist and senior writer at Bankrate, and you have over 2 decades of experience covering real estate. And since 2019, you've served on the board of the National Association of Real Estate Editors. And last time we had you on 6 months ago, we were talking about this real estate commission lawsuit where basically currently in the U.S., well, is it something like around 5 or 6% of the real estate commission fees? What is that standard? Is it 5% standard industry wide, 6%?
Yeah, there's really not there's technically not a standard, but yeah, on average, it's about 5% of the price of the home is paid out as commission to agents, and usually about 2.5% to the listing agent and 2.5% to the buy side agent.
Right. So since that lawsuit, basically the person who was selling the house on the 5% average, they were paying the whole 5%. They were paying 2.5% of that or half of that to their agent for listing the house. And then they were paying the other half of that or 2.5% to the agent who was buying the house. And then basically the lawsuit kind of decoupled that. And so the question is now, we're essentially like 6 months later. So What's an update? Has anything changed? Has things stayed the same? What's the update?
Yeah, it's hard to say. So these new rules took effect in mid-August. So if you started shopping for a home after August 17th, you had to, and you wanted to have an agent representing your interest, you had to sell a buyer, or I'm sorry, you had to sign a buyer agent agreement. So that started August 17th. So about 3 months ago. It's hard to say exactly, excuse me, what's happening. I'm getting kind of mixed reports. So some listing agents are saying that their sellers are willing to pay the buy side commission, just to make their house stand out in a more competitive market. We're not in that same super intense sellers market that we were for a few years during the pandemic. So some significant percentage of sellers are agreeing to cover the commission. So in those cases, it's just business as usual. It's the entire commission's coming out of the seller's proceeds at closing. And then there are some percentage of sellers, and there aren't any statistics as far as I know, but some percentage of sellers are saying no, that if the buyer wants to be represented, the buyer can figure out how to pay for that themselves. And so I would still say it's so new that there's no real clear picture that's emerged. One interesting thing is that commissions have started to come down a little. That Redfin, the big real estate brokerage, put out some research on that front and showed that the commissions have come down slightly over the past few months. So not hugely, but the whole idea of this lawsuit and the settlement was that ultimately it would somehow lower commissions and lower costs to consumers.
The last time I had you on, I mentioned, my buddy that's been a real estate agent out in Colorado for 41 years now, and he didn't think anything would happen. And I just had a buddy that actually lives in the Asheville, North Carolina area recently. He had his house for sale. So he was like, okay, I need to get an agent. I want to sell my house. And he contacted over a dozen agents and it's like, hey, I don't want to pay I guess there it's like 6% is standard, but he's like, I don't want to pay the 3% to the buying agent. I'll just pay the 3% to the listing agent. He contacted over a dozen real estate agents. None of them agreed to list his house. They're like, no, like you're going to have to pay the full 6%. And if not, we're not going to take your listing. So then he finally found an agent who agreed to do this. And then he had somewhere around like 5 or 6 offers, and all but one, the buying agent was like, yeah, you're going to have to pay our commission as well. So he turned all of them down. Then he found a all cash offer, and they didn't care. They didn't even have they bought multiple properties. I think they're an investor, so they didn't actually have a buying agent. And then of course, Asheville got smashed with Hurricane Helene, and then they ended up backing out of that deal. So he's kind of at square one, but it seemed like nothing actually changed. I mean, he had to contact over a dozen brokerages just to find one to agree to it. And then when he did have offers, they had that built-in commission for the seller.
Yeah, and I think that just illustrates how new that this is. And I mean, I think there's going to be a sort of a time period where things shake out and settle down, and everyone figures out how it works. Yeah, that sounds unusual to me. I mean, I don't know if there was some communication breakdown there between what your friend was asking for and what the agents thought he was asking for, but yeah, it's definitely a confusing time around commissions.
In this particular case, he's in the Asheville area. And so this kind of brings to light what happens to the housing market after natural disasters. You live in Florida. Hurricane Helene also impacted Florida. And I had a professor of law, but he specializes in insurance. And we were, or, homeowners in insurance, and we were discussing what happens after a storm. And he says that generally you have kind of like pessimism. So the housing prices go down. People think it's the end of the world. And then after the storm, you have more regulation. It kind of set in. And then you have houses that were destroyed, and whether it's wildfire, hurricane, flood, whatever. So you have a decrease in supply. So like a year later, ultimately the prices go up. You live in Florida. I'm sure you've been through this numerous times. So what actually, like, not just Asheville specifically, but what happens, generally speaking, with the housing market after one of these natural disasters?
Yeah, from my observation, it seems like the housing market goes straight to the second part of the scenario you just described, which is lack of supply, so rising prices. And that's what happened on the Gulf Coast of Florida, the Fort Myers Beach, and some of those areas on the Gulf Coast were hit pretty hard by a storm a couple of years ago. And that wiped out a lot of the older, more affordable structures. And in many cases, the owners of those homes weren't insured sufficiently to rebuild, because another side effect of a natural disaster is that there's shortage of labor, there's a shortage of materials, so those things rise in price as well. So it's probably costs more to rebuild immediately after a natural disaster than it would have cost to build before the natural disaster. And so in Fort Myers Beach, for instance, like the Wall Street Journal has been chronicling this, what were sort of affordable middle class style homes have been replaced by mansions that are if not mansions, at least luxury homes that are certainly far more expensive than the previous properties on those pieces of land. So everywhere in the country, just about, there is a shortage of housing. And when a natural disaster comes in and removes housing from the housing stock, it just causes upward pressure on prices. So, not as if we need any more upward pressure on home prices, but that's just one more factor. So, yeah, I would say in general, the effect of natural disasters has been to reduce the supply. And in some cases, then you have, more affluent buyers seeing this as an opportunity to buy, and they're coming in and squeezing out sort of the people who might have been able to afford what was there previously. And then you mentioned regulations. So, in Florida, ever since Hurricane Andrew, there have been, much stricter building codes, which means it costs more to build. And that's worked out well generally. I mean, the buildings in Florida are much more storm resistant. And so you don't see homes falling over in hurricanes like they did during Andrew, infamously. So the built environment is much stronger, but that also just means it's more expensive to build a house. It's more expensive to maintain a house. It's more expensive to insure a house. And then it seems like in California, the things are going in that direction as well. So part of this is being driven by insurance or unavailability of insurance. So Allstate and some other major carriers have pulled out of California. And so it seems like that same cycle that Florida experienced is going to happen in California, where homeowners are taking on more cost, more risk, just to weatherproof, in this case, fireproof their homes. And so I think in the long run, it makes everyone safer. It makes the homes higher quality, but it's also just creating more upward pressure on home prices.
Do you think that it has kind of a short-term effect? But what's the long-term effect, I guess, then?
Well, I would say the long-term effect of of storms, I mean, or of extreme weather events. I mean, I guess in the Florida experience, the the houses are just a lot stronger. So I'm always, I've lived in Florida long enough that I'm just accustomed to seeing concrete block homes. Any new construction is entirely concrete block. The windows are impact resistant. The doors are wind rated. The garage doors are impact resistant, and so essentially for the last 20 years, everyone in Florida has been building these mini fortresses. And I'm always kind of shocked when I travel to other parts of the country and see wood frame homes going up. So I would say for the long-term housing stock in Florida is just that it's essentially a better product. It's stronger, it's sturdier. I mean, we'll see, what happens in the future. Who knows if anything can survive a direct hit from a Cat 5? But in general, it seems as if the quality of the homes has gone up a lot. And then in terms of Asheville, that's definitely an unusual situation. I know there have been hurricanes that have gone through there before and caused damage, but this seems like a rather severe case. So I don't know. It's hard to predict exactly what's going to happen there.
Yeah, because I mean, I got my buddy lives outside of Brevard, and he's got friends that he's basically saying FEMA's come in and then they evaluate the property damage, and if over 50% of the property's been damaged, then they have to raise it, 4 feet. And of course, none of these people really had insurance because none of them really expected to get flooded out. So not only do they have to rebuild their home, but then they have to rebuild the home 4 feet higher. And if they don't, then no one can build there, which kind of seems reminiscent of what happened in Lahaina, where you had this historic district and you couldn't do much modifications to these houses because they were in a historic district. The fire comes out, wipes these houses out, and then all of a sudden now like investors come in because now all of a sudden you can build like a high-rise condo or hotel. And the Brevard is also a pretty desirable area outside of Asheville. If you're into bikes and brews, it's a pretty desirable location. But it seems like a lot of these houses just aren't going to be rebuilt based on the FEMA and is this standard, like where FEMA just comes in and all of a sudden now they got new floodplains and they're putting in new regulations?
Yeah, I think FEMA's constantly redrawing those maps, and I mean they're never 100% accurate, as that whole episode showed. I mean, no one was. I don't think any of the disaster models had accounted for a storm that would carry a bunch of water over the Gulf of Mexico and then dump it all in the mountains of North Carolina. So, yeah, I mean, clearly the FEMA maps weren't accurate, and I mean, in the end, we the taxpayers are the ones who are funding FEMA, so we actually want them to be more strict, more realistic about these requirements. So, yeah, it's definitely a balance. I mean, it's not fun to be the homeowner who's told you have to come in and dump 4 feet of fill on your land and rebuild your house. But by the same token, I don't know how sustainable it is for houses to continue to be rebuilt in flood zones. That's been a constant problem with FEMA for decades. But yeah, FEMA's constantly changing the maps. They're never perfect, and I guess kind of one of the hazards of being a homeowner anywhere in the world, but being a homeowner in the U.S., you're at risk of climate events, and if you want to have insurance, you're probably going to have to play by someone else's rules.
How does like the Airbnb and short-term rentals factor into the equation? You figure like, you're in Florida, so you're in a pretty tourist desirable area. Asheville's a very touristy area. Tourism's obviously going to take a massive backseat after one of these storms. I mean, a lot of these restaurants and I mean, hell, I think Asheville didn't even have like fresh water for like over a month. They're obviously not having any tourism as the supply dwindles from the regular homeowners. But then do you have like an increased supply onto the market of like these Airbnbs? Is maybe you're trying to sell it when you don't have any people to come in and be there for tourism?
Yeah, that's an intriguing question. So, yeah, I mean, obviously there are a lot of Airbnbs, a lot of vacation rentals in the Asheville area. The tourism probably is going to be hampered for a while, just because as you mentioned, all the infrastructure issues. I think the Blue Ridge Parkway is going to be closed for a while. So, yeah, I just say it's definitely not an easy time to be an Airbnb owner right now. Yeah, it's a good question. I don't know. I wonder if that might be sort of a release valve. So, I mean, obviously that was a hot area for Airbnb investors. Everyone was playing the revenge travel trend and buying up vacation homes and building these properties up with as much debt as they could. So, and it's one of those. It's a good bet as long as things are going great, and then once the tourism traffic turns off, maybe it's not so great.
How do you see kind of the Airbnb market in general? We've had a lot of municipalities that have actually restricted short-term rentals. California, I know Colorado, New York City, a lot of desirable areas. What do you think is the trend going forward on Airbnbs?
Yeah, I mean, it seems like it's not going away. In Miami, for instance, there are a number of developers who have started catering to short-term rental owners. I talked to one condo developer in Miami who said that built a condo on Brickell, which is one of the swanky areas of Miami. And one of the rules for the owners of condos was that you can't use these places as short-term rentals. And the owners just found ways around the rules. So even though it was allegedly not, a building that did not allow short-term rentals, there would be, people rolling their suitcases in and out. And so the developer finally said, well, there's no way to fight this. So they switched their business model and started building units specifically for Airbnb owners. And they're selling condos for $500,000 and doing pretty well. So that seems to be a trend. There in a number of cities around the country, there are developers who are designing specifically to sell to Airbnb owners. And so that definitely creates some downsides. I mean, there's a shortage of housing. It would probably be healthier for the economy, healthier for homeownership if those units were being marketed not to Airbnb owners who already own 2 and 3 places, but to first-time buyers who can't afford homes. But the reality is vacation rentals are a viable business model, and they're definitely going to take some of the some of the housing supply is going to be redirected away from owner occupants and towards vacation rental owners.
And you said they kind of find some like loophole to do some short-term renting anyways. What are some of those loopholes that they're able to kind of exploit?
Well, so it just depends on the municipality. So I think some cities have banned short-term rentals altogether, but I think that's the minority of cities. I mean, in Miami, these projects were fully vetted, fully approved by regulators. So I mean, in that case, I think it's essentially built almost as a hotel rather than as residential property. But yeah, that's a good question. I've not delved into the loopholes. I know a lot of cities just haven't been willing or able to really do anything about short-term rentals. If you've got a smaller municipality that's suddenly has these places popping up, it's kind of like back in the old days of Uber when Uber was picking up and dropping off people at airports, and the taxi companies were mad, but there was it was almost impossible to regulate somebody driving around in a private vehicle and taking rides off an app that regulators and public officials didn't really have any insight into.
Yeah, I mean, if you look at like any law book, and between state, local, federal regulations, it's thousands of pages. Anything you do is pretty much illegal, including like jaywalking. Yet, like you actually have to have someone to enforce these things. You could have all the short-term rental laws on the book, but if no one's there to enforce it, it doesn't really mean much, does it? Or if the penalties, really like, I don't know, $50 fine or something, you just pay the fine and make the cash.
Mm-hmm. Yeah, well, the intriguing thing that this condo developer in Miami told me was that the developer was imposing a ban on short-term rentals by threatening a fine, and so this wasn't a regulation, but this was a private developer saying if you break our rules, we're going to fine you, and still the owners were willing to risk the fine because they just figured they were going to make enough money before they got caught that it wasn't really going to affect their bottom line.
And kind of just circling back to the start of this, where we were discussing the real estate commission lawsuit now that the fact that we've had these policy changes, and then using my friend's example. So basically, ultimately, is nothing's going to change, right? Is that kind of the bottom line if you're buying or selling houses?
Well, something has changed for sure. So there's just this extra layer of paperwork, this extra layer of complexity that buyers now have to deal with. So for decades, if you were a buyer looking for houses, you could show up at an open house. You could even have a buyer's agent tour you around and drive you around and take you to different places. And you could do all of those things without signing an official buyer's agreement. I think probably the smart move for agents and the savviest realtors would require that buyers sign buyer agent agreements, but that it wasn't mandatory, where there were no industry rules saying you must do this as a buyer. So now what changed as of August 17th is that if I'm a buyer and I want to have an agent represent me in the process, I must sign a buyer agent agreement. The one exception is open houses. As a buyer who's unrepresented, I can show up at an open house. But if I don't have a buyer's agent and I call up a listing agent and say, hey, I want to see this property, their first question is going to be, okay, so what have you signed an agreement with a buyer's agent, and what are your plans there? And so if the buyer can say, well, I'm not represented, I don't want to be represented, I'm representing myself, then I guess they would the listing agent would agree to give a tour. But that's I think even that is what that scenario that I just described is probably a level of just legal complexity that probably most buyers aren't really thinking about. Most Americans buy a house every 10 or 12 years or so, and they're just not real familiar with the intricacies of real estate law. And then first-time buyers in particular are brand new to the process, and they don't really know what's going on. So this is just one more thing for consumers to figure out. And one more piece of paper that they're gonna have pushed in front of them by a real estate agent. And then I guess back to your bigger question about what's changing. So that's I guess that's a minor change, that you have to sign this agreement if you want to be represented by an agent. So it's definitely a change, but then I guess you could debate whether that qualifies as a significant change or is just sort of a nuanced change that's not really going to change the overall housing market. In general, this settlement is not going to revolutionize the amount that consumers pay in commissions. It's not going to be a huge. It's not going to be a watershed event in terms of money changing hands between consumers and real estate agents. So far, I think it's probably more noise than signal. So I guess it's your question. Yeah, it's changing some specific things, but probably some small specific things rather than changing anything major in the way Americans buy and sell homes.
The story I was telling you at the beginning, you think that's just going to kind of be standard? Because a lot of people don't even know about the changes, and the real estate agent is just like, oh yeah, this is just standard, like. And what buying agent is going to bring forth customers if they're not getting a commission? Or if you're right, like I said, where he had to talk to a dozen agents even to get one to even agree to it. And then after that, all the agents that were making offers were like, yeah, you get to pay the 3% commission for me, the 3% commission for your agent, except for the one all cash offer.
Yeah, I don't know. It's still early. We're in it's the messy early days of these rules. And I guess one thing to keep in mind is that the real estate industry, or at least the real estate brokerage industry, has always been sort of this chaotic, very loosely regulated, loosely organized collection of individuals. So there are 1.5 million members of the National Association of Realtors, but those 1.5 million people are, for the most part, independent contractors. A lot of them only do a couple deals a year. They're under no obligation to show up at an office at any particular time or dress in any particular way. So it's just always been a very loosely I don't know if I want to say loosely regulated industry, but it's always been sort of a freewheeling industry in that it's, something like a commission settlement sounds like it's official and like it means that everything's going to automatically change the next day. But the reality is you've got a million and a half independent contractors out there, and it's, churning the ship doesn't happen overnight. Or I guess herding cats is the the phrase that real estate brokers always like to use.
Considering it's the biggest purchase of people's lives, and the vast majority of people's wealth is the vast majority of their wealth is wrapped up in their house, to have kind of like a loosey goosey buying and selling process seems. I mean, I guess that seems fairly American, I guess.
Yeah, well, I don't know if I would even say that the process itself is loose, but it's just because there are. I mean, once the process starts, there are very specific things that have to happen in terms of the contract and the closing, and if there's a mortgage, the appraisal and the inspection. So yeah, it's not really even the process itself that's undefined, as just this reality that you've got 1.5 million self-employed people out there who are essentially are the main point of contact for their consumers. Unlike other industries like, banks, for instance, if you go into a bank branch, chances are that you're going to hear the same thing from employees, no matter which branch you go into. And it's because everyone you interact with in the branch is an employee of that bank. The bank is basically telling them what to say, what to wear, what to do, and that's never been the case in the real estate industry.
So we're recording this episode basically mid-November of 2024, and we just had a recent presidential elections, and currently the prime interest rate is 7.75%. And we all know one of the biggest factors in buying a house, at least in terms of the price of the mortgage, is the interest rate. Just for an example, if you buy a $400,000 house with a 4% interest rate, your monthly payment is going to be right around $1,900 a month. If that interest rate is 8%, kind of what we're at right now, then that payment, instead of being $1,900 a month, is over $2,900 a month, just by changing that interest rate. So do you think like having a change in the presidency, or just going into 2025, that we will see that interest rate decrease? Or what do you see with that?
Yeah, probably the opposite. And just one minor fact check. So as of Bankrate's most recent weekly survey of lenders, so November 13th, the average mortgage rate was 7%. And so that was unchanged from a week ago. And so November 6th, November 13th, the average was 7%. Intriguingly, that number was all the way down at 6.2% in mid-September. And that was the mortgage rates had fallen around excitement that the Fed was going to cut interest rates and keep cutting interest rates. And that narrative has really shifted over the past 6 weeks. So mortgage rates have gone up from 6.2% to 7%, even though the Fed has done an additional quarter point cut during that time. And now the dominant narrative in the mortgage market is that Trump's victory means that federal deficits are going to continue to balloon, that Trump will stick with the tax cuts that he signed off on back in 2017, and that he's shown no appetite for cutting spending. And so the result is going to be trillions of more dollars in deficit spending. And so the idea there is that the main benchmark for the 30-year fixed rate mortgage is the 10-year Treasury yield. And 10-year Treasury yields have been going up on expectation of wider deficits. And the idea is that the more the U.S. government borrows, the more money it's going to have to, the more debt it's going to be creating, and the higher interest rate it's going to have to pay to attract investment in U.S. debt. So the new narrative is that Trump is going to mean bigger deficits, and bigger deficits are going to mean higher mortgage rates. And so that's at least what we've seen so far. So since mid-September, mortgage rates are up 80 basis points, or 0.8 of a percentage point. And the consensus now is that mortgage rates aren't going to go much lower I don't know that anyone foresees them going much higher, because it seems as if the Fed is going to continue to cut rates. Even though the Fed doesn't directly control interest rates, it does influence mortgage, or I'm sorry, the Fed does, of course, directly control its own benchmark interest rate, but the Fed does not directly control mortgage rates. And so the consensus is that even as the Fed continues to cut rates, that's going to be offset by these new concerns about the federal deficit pushing up 10-year yields.
What do you think's going to be, the next, say, few years? You think we're going to see like a decrease in housing prices, decrease in the interest rate, or are we going to see an increase on the interest and the housing prices?
Yeah, the Fed is going to continue to cut interest rates by all accounts, but in terms of mortgage rates, they're at 7% now. I mean, the consensus is they might fall a bit, but they're not going much lower than 6%. And in some ways, you don't necessarily want mortgage rates to fall. I mean, the reason that mortgage rates fell in 2001 was because there had just been a terror attack that roiled markets. Mortgage rates stayed low for a long time, as the Fed kept interest rates very low. And then mortgage rates really fell during the pandemic. I mean, the thought was we were going into a global economic calamity, and that was what pushed mortgage rates down below 3%. So, low mortgage rates are great if you're a borrower, but they generally mean that something else has gone very wrong in the economy. So I just offer that up as a caution about how hard you want to cheer for lower mortgage rates, because when mortgage rates fall, that generally means that something else not so great is happening. But I think the consensus is mortgage rates at 7% now. Maybe they're going to go down as low as 6% next year. The National Association of Realtors was saying they could go down to maybe 5.5% in 2025, but with the caveat that deficits are going to put upward pressure on mortgage rates. And then the other factor is that inflation just came in higher than expected. The job market's been stronger than expected. So it seems like it's getting a little more difficult for the Federal Reserve to justify significant rate cuts. And I know I keep saying that the Fed doesn't directly control the mortgage rates, but it does have an influence on mortgage rates. So in terms of mortgage rates, they might go down marginally. We're not going to see anything like the 3% rates we saw during the pandemic, but that's generally good news. And then in terms of home prices, there's just such an ongoing shortage of homes for sale that it's hard to envision a scenario where home prices fall. They've been continuing to go up, and really it was pretty shocking that as mortgage rates doubled, or more than doubled, from 3% in late 2021, early 22, all the way up as high as 8% a year ago. Mortgage rates doubled. Normally, you would think that would just kill the housing market, and that did in fact kill home sales, or significantly reduce home sales. But home prices kept rising. And so that just reflects this shortage of homes for sale. The U.S. population is growing. There are a lot of renters out there who want to be homeowners. There are a lot of affluent people who want to own second homes or investment properties that they can use as Airbnbs. And so there's just not enough housing supply and a whole lot of demand. And that's really what's been propping up prices for a long time. And it seems unlikely that that's going to change.
Right. I mean, it seems like a lot of people would just predict like we're going to have this collapse in housing prices. They all think of like, oh wait, like prices can't go up forever. But in 08, there was an actual, like they were overbuilding houses, and now we don't actually have an overbuild. So even as interest rates increase, it doesn't really mean people are not buying. Is that kind of correct?
Yes. Yeah, exactly. So back in 04, 05, 06, there was a housing boom that was characterized by very aggressive building. Home builders were building a lot of single family homes. They were building condos. Apartment buildings were being converted to condos. The developers were, instead of building hotels or office buildings, were developing condos. So there was just the home prices had gone up so much, and developers, builders saw that and responded by building a lot. And then the other factor was that before that point, essentially anyone could get a home loan for any amount. There were the infamous ninja loans, the no income, no job or assets, the zero down loans, the negative amortization loans. So all of these it was a very loose money supply, very easy to qualify for a loan. Mortgage fraud was rampant. And so today, neither of those factors exist. Builders were so burned by the Great Recession that they haven't ramped up their activity to anything near the pre-financial crisis levels, and so that's helped contribute to the shortage of homes for sale. Builders are primarily building higher priced homes. So for decades after World War II, developers were building a lot of starter homes. That they're not doing that anymore. They can make a lot more money selling $800,000 homes than they can $300,000 homes. So that's what they're doing. So there's no oversupply coming from builders. And then in terms of the mortgage market, there was just an absolute flurry of mortgage regulation that followed the financial crisis. So Dodd-Frank and a whole bunch of other federal laws. And so it's very difficult to commit mortgage fraud right now. It's just not as rampant as it was during that housing bubble. And lending standards are much higher. So the average credit score among mortgage borrowers has been close to 800. So it's pretty hard to get a loan unless you have solid credit. So that when that bubble burst, it created sort of this self-perpetuating cycle of people who had put very little money down on homes that were suddenly losing value, had no incentive to stay in their homes, so they were letting them go to foreclosure or selling them for a loss in short sales. And that's not the case now. The typical homeowner has, I don't know how much equity, but it's significant. It's 20, 30, 40%. I'm not going to walk away from a $800,000 home that I have a $250,000 stake in. And then the other factor has been that home prices are rising. And so even if I'm a borrower who's run into financial trouble, I'm sitting on all that equity. My house is worth more than it was a year ago or 2 years ago or 3 years ago. If I really can't pay the mortgage, I'm just going to sell the house and cash out. And so there essentially are no distressed sales right now. Foreclosures and short sales are just a minuscule percentage of the overall market. And so there's just none of that downward pressure on prices that we saw during the Great Recession.
Jeff, do you do anything with commercial real estate?
Yeah, I do.
We've seen buildings in San Francisco and New York City kind of sell for pennies on the dollar recently, especially as a lot of these office employees are working remotely.
Mm-hmm.
So, I mean, to me, I always kind of think like it's just, I mean, you see some reports of companies saying like, hey, we need these employees back into the office. But then you see reports where maybe they'll work 2 or 3 days a week from home, which means you could kind of downsize and rotate some of those employees. What do you think that the real estate or the commercial real estate market will look like going, I don't know, say the next 5 years?
Yeah, well, if you're referring to office specifically, like definitely early on in the pandemic, the office market got really rocked by the recession by the pandemic for those reasons that you just described. But that's changing. It seems like that's shaking out, and this idea that there was going to be an office Armageddon has sort of lost some steam. One reason is that a lot of employers are having employees come back into the office. So I was just in Seattle at Amazon's headquarters where Amazon is telling people they have to be back in the office. I mean, to me, I looked around, I looked at all the huge buses pulling up to office buildings and dropping off workers. And I saw all the people in the cafeterias and bringing their dogs to work. And it didn't look to me like there was really an office Armageddon. It looked like things had returned to something like their pre-pandemic norm in terms of the workers, office workers going into their offices. But obviously that's an unusual case. Seattle's a thriving city. Amazon's a thriving company. Definitely, there some of the more marginal office properties. What's known as Class B properties. So the older properties, the maybe properties in suburban locations that aren't quite as sexy. I think those are struggling, and the consensus is that office developers and employers have to do more to make the offices a place that workers want to come to. So it's not good enough to just have some fluorescent lights and some cubicles. It's like the employers and office developers are almost like hospitality and retail developers, and that they're trying to create destinations. And it's sort of the days are kind of gone when when an employer just say, well, if you want your paycheck, you better come into the office, no matter what it looks like or how inconvenient it is. So that has shifted a bit. And so definitely the quality of offices, the way offices are designed, I think is changing and will continue to change. But it's intriguing. Like in South Florida, for instance, where I live, the developers are building just this very high end, very expensive office space, and they're finding tenants to take it. So it seems like at the very high end of the market, there's still demand for space. And I don't know. It's hard to know what's going to happen with some of those older, less expensive buildings. But it seems like in some cases, at least, the office Armageddon is sort of resolving itself. There are certain cities, like I know St. Louis has a very high office vacancy rate. Louisville's been struggling with very high office vacancy rate. The city of Atlanta just bought a large office building downtown and is going to convert it, or at least some of it, to affordable housing. So certainly, I wouldn't want to say that the office market has completely returned to health, but there's kind of that storyline back during the pandemic that nobody was ever going to go into an office again is sort of. So I think that's faded. It was nobody was ever going to go on a cruise ship again, and nobody was ever going to go into the office again, and yeah, I mean, I guess the cruise companies and office landlords definitely felt pain during the pandemic, but it seems like those industries are recovering.
My last big question, I've done quite a bit of podcast on population decline, fertility rate decline. I mean, the U.S. has kind of been able to buffer it because, as the U.S. has had a decrease of fertility, we have immigration, so it kind of like balances out. But in the same time, in the U.S., we can't kind of deny the fact that the population is getting older. You got a bunch of baby boomers. Was it this year? I think in 2024, like something like 11,000 baby boomers a day are retiring, something along those lines. And so as you get older, then you're of course going to have kind of different requirements. If you're 80 years old, you don't need a 4-bedroom, 4-bathroom house. If you're living by yourself and with a acre yard or something like that you're out there mowing the lawn and raking leaves and things like that, maybe you want to move to the villages of Florida or move to, Tucson, Arizona or something. So how do you kind of see, and every year the U.S. is kind of getting a little bit older. How does this affect the real estate market? And then also, do you think that in 20 years with a decrease in fertility rate that we might actually have too many houses? So we're ultimately having different kind of housing and possibly too many houses? Or do you think that population decline is kind of over exaggerated?
Yeah, I don't know. So I think the latest census figures have the U.S. population at like 337 million, and so what's that? That's like it's up 75 million people over the last 25 years. So I don't know. I think I would be skeptical that there's going to be any significant population decline in the U.S. Or any sudden surplus of homes. I don't know. It seems unlikely to me. I mean, even during the pandemic, I mean, it's certainly there were a lot of people who died from during the pandemic, but it wasn't enough to really change the overall trajectory of the population trend. Yeah, it's a good question. I don't know. I'm just trying to think through this. So Americans are definitely living longer. I know there have been those stats about life expectancies declining for the first time, and it seemed like a lot of that was tied to I guess, a combination of public health issues, the obesity epidemic, the opioid crisis, the pandemic. But it seems like the affluent people who own a lot of homes are living longer and longer. And so I don't know how that skews the scenario that you're talking about. But yeah, I don't know. I think it's going to be a long time before we see any kind of significant population decline. So like certainly there have been pockets of it. Cities like Detroit and Cleveland have seen huge exoduses, and so they've had surpluses of housing supply. It's hard to see that happening nationally. And I know, like, 5 years ago or so, speaking of shifting narratives, there was that thought that there was going to be a silver tsunami, like all these baby boomers were going to sell their homes en masse, and there was going to be a oversupply of homes. I mean, now everyone has realized, okay, that was never realistic. It's not, Americans are living longer. It's not as if the boomers are suddenly going to just, start dying in mass or die on the same day. So it's been a much more gradual shift than might have been suggested by some of those catchy titles like the Silver Tsunami.
So you don't think we'll see a massive shift then in some of the buying choices of some of the elderly people as they get older, maybe moving more? I mean, I think isn't the Villages in Florida the fastest growing community in the U.S., and it has been for quite some time? Maybe the fertility is going to be decades off, but the changing buying patterns of some of these boomers, like you mentioned, the silver tsunami years ago, I think that was a little bit premature, but at some point, there has to be some gradual shift in the buying decisions, right?
Yeah. I mean, I think there definitely will be a shift, but I think it's going to be gradual. I mean, the oldest baby boomers are like 70 plus now, so it's that trend has already started to happen in terms of the aging of the boomers, but I don't know. It seems like that hasn't, aside from some of these isolated examples like the Villages growing. I mean, it's been the fastest growing community. It's been the fastest growing off a small base. So, some small number of boomers are moving to the Villages, but most boomers are staying in the homes that they've lived in for decades.
Right, they're aging in place, as they say, right? Isn't that the terminology they use?
Yep.
Well, Jeff Ostrowski, who's an award-winning journalist and senior writer at Bankrate, I really appreciate you joining us today. Two final questions. Where can people find you? That information, then just leave us with a final thought before you bounce out of here.
Let's see. You can find me on bankrate.com. Just search Jeff Ostrowski on Bankrate. You can find me on LinkedIn. Final thoughts. I don't know. You stumped me with that population question. I'm still thinking through the possibilities of that one. So thanks for asking one that made me pause for a second.
My dear friends, that is it for this episode of El Podcast. Once again, if you're not yet subscribed, please subscribe on YouTube as well as Rumble. You can also find us on Spotify and Apple Podcasts or wherever you get your podcasts from. We thank you all from the bottom of our hearts for watching and listening, and we will see you on the next episode.